Good afternoon. On behalf of the Center for Community Progress, I'd like to welcome you to today's Cornerstone Webinar. My name is Justin Goddard, and I serve as the Program Officer for National Leadership and Education here at Community Progress. Cornerstone is our webinar series, which equips participants with the building blocks to understand and solve tough challenges related to property vacancy, abandonment, and deterioration. Before turning it over to Rob to kick off today's conversation, I want to mention that we will allow time at the end of the presentation to answer questions. If you have a question during the presentation, please click on the Q&A icon at the bottom of your webinar browser and type your question into the Q&A box. We will share a video recording from today's presentation in the week following. If you experience any technical difficulties, please send us a message by clicking on the chat icon at the bottom of your browser or by sending an email to Justin Goddard at jgoddard@communityprogress.net. Finally, Community Progress has created a COVID-19 resource center, which can be accessed on our website and provides resources and updates for neighborhoods looking to prevent vacancy, abandonment, and deterioration related to the current economic and health challenges. And with that, I am going to turn it over to Rob.
Good day, everybody. My name is Rob Finn. I am the Director of Policy and Research for the Center for Community Progress. Thank you for joining us today for this important discussion. And I want to thank in advance my panelists who are joining us today to talk about the Neighborhood Homes Investment Act. The Neighborhood Homes Investment Act Coalition is something that Community Progress has been involved in for several years. And we are really encouraged to see the degree of support that the neighborhood home, that I will call it NIA because it's so hard to say sometimes. So NHIA, which we affectionately refer to as NIA, and which will help us from absorbing too much time saying all of the words. So NIA is something that we have supported for a long time and that we have been excited to see receive such bipartisan support in Congress, both at the House level and in the Senate. There are bills that have been introduced in both chambers that we're going to hear some discussion about how the bill works and some of the political movement behind it and both where it's come from and where it's heading. And then we're going to hear from leaders working in communities at land banks and community development organizations as to how they expect to be able to leverage NIA to improve their communities. So I'm really thrilled to be joined today by Carey Shea, who's one of the founders of the Neighborhood Homes Investment Act Coalition. Also very proud to say that Carey Shea is now a member of the board of the Center for Community Progress, and we are very lucky to have her. Also want to thank the other panelists who will also present. David Mann is the president and CEO of the Lucas County Land Bank. Chris Norman is the executive director of the Fulton County City of Atlanta Land Bank Authority, and O.J. Alexander is the executive director of Home by Hand based in New Orleans, Louisiana. With that, I am going to turn it over to Carey Shea to talk about the Neighborhood Homes Investment Act movement.
Thank you, Rob. Let me see if I can get this up. Okay. So I am from Hartford, Connecticut, and Hartford has inspired a lot of my thinking about the neighborhood homes. Justin, I am having trouble forwarding this.
Hi, Carey.
Making this go forward.
Click on go to the actual PowerPoint file. So it should be, and then click on that. Yep, there you go.
Very good, thank you. So I'm from Hartford, Connecticut, and the story of Hartford is similar to the story of many of the cities and towns that you all are from. Hartford in the 1900s was one of the wealthiest cities in America. It was a center of manufacturing innovation, and today would have been the Silicon Valley of the East Coast. Colt Arms Factory was located there, as was the Underwood Typewriter Factory, the Seth Thomas Factory, and a number of factories making sewing machines, cars, bicycles, etc. More importantly, probably, the city of Hartford was the insurance capital of the world, and generated a lot of wealth through this industry. It was also a cultural hub, and Mark Twain, after traveling the world, decided to build his beautiful home in Hartford, saying that it was one of the most beautiful cities he had ever seen. But while Hartford was experiencing all of this prosperity, there were actually forces at work that were undermining the sustainability of the city. This is a map from 1933 that was produced by the Homeowners Loan Corporation. The right side of the map is Hartford. The left side of the map is West Hartford. Within 40, 50 years of this map being produced, the city of Hartford had been severely disinvested and was experiencing poverty and population loss. And the left side of this map, which is mostly in green, was enjoying the benefits of reinvestment. In 1959, I-84 blasted through the city of Hartford, making it easier for people to move to the surrounding suburbs and use Hartford only to come in to work. The federal government underwrote loans and made this suburban expansion more popular. In 1969, at the assassination of Martin Luther King, Hartford, like hundreds of other places across America, erupted with civil disobedience, thus spurring the out-migration from Hartford even further. But the city did not completely fold and collapse. In fact, the art scene remained very vibrant. The city attracted immigrants from Trinidad, Jamaica, and Puerto Rico. And at this point in Hartford, 40% of the population is actually Spanish speaking. So while the downtown was able to sort of hold steady, the neighborhoods suffered widespread decline, abandonment, and deterioration. Like many of your cities, the housing stock in Hartford is pretty old. 77% of all the homes in the city of Hartford are over 40 years old. The median prices are relatively low for the region. And the home ownership rate is extremely low, while the vacancy rate is pretty high. But oddly enough, the thing that sort of is working against us the most is the fact that 55% of our homes are 1 to 4 family homes. And this presents a problem in a declining city because there is no significant funding or financing available to help restore this housing stock. In the city of Hartford, like in many of your cities, a home in need of renovation can be purchased for approximately $90,000, $100,000, may need $140,000 in rehab, coming up with a total development cost of $230,000. The problem is that this house, even renovated, is only going to appraise at about $170,000, leaving a gap of $60,000. And this appraisal gap, or value gap as it's known, is what is preventing the revitalization of neighborhoods throughout the city. And so in March of 2016, after spending a lot of time looking at the existing housing finance programs, I came to the realization that there really was nothing, no source of permanent financing that was reliable and significant, that those of us in these 1 to 4 family communities could tap. And we organized in New Orleans a meeting of housing and community development experts from these organizations. We formed the Neighborhood Homes Coalition and continued to meet every 2 weeks by telephone and come up with what is now a piece of legislation in both the House and the Senate. And this is what I'm going to talk about. So we are proposing a new federal tax credit to attract capital to distressed neighborhoods for new construction and substantial rehabilitation of 1 to 4 family housing. The way it would work is that the federal government would allocate $6 per capita to the states, to the housing finance agencies. The states would run the competitive RFPs and make awards to what we're calling NIA managers or sponsors. The managers would use the allocation to raise equity capital from investors. This equity capital, these subsidies, would be eligible to be used in census tracts that had above average poverty rates, median family incomes below 80% of AMI, and median home values below 100% of the area median house value. The tax credit would be used exclusively for 1 to 4 family owner-occupied houses, condominium units, cooperative housing, and community land trust housing. Each project would require a $20,000 minimum rehab per unit. The tax credit would cover up to 35% of the total development costs, and eligible building acquisition costs would be limited to 75% of the rehab or construction costs, and land costs would be excluded. So a couple of years ago, I was in Detroit and came across this house. And so this is what the Neighborhood Homes Investment Act might be able to do for a home like this, a 2-bedroom, 3-bathroom, 2-unit. So a purchase price is $6,000, an estimated rehab cost of $140,000. The developer fee, which is an eligible cost, would result in a total development cost of $156,000. The appraised value at resale was estimated at about $110,000, leaving a total appraisal gap of $46,000. So to compute the eligible basis and the amount of the tax credit for this project, we take the acquisition plus the rehab cost, comes up with $156,000. $156,000 times 35% is $54,600. So that would be the amount of tax credit available for that building. Only 46 is estimated as needed. And so this is a project that would work. This is an owner-occupant program. So the homes upon rehab or new construction would have to be sold to families at 140% or less of the area 10% of the homes sold to households at or below 80% of AMI. And so to claim the neighborhood homes tax credit, the investor claims the tax credit when the home is completed, inspected, and occupied by an eligible owner. Investors are not subject to recapture. However, if the home sells within 5 years, the homeowner must pay up to 50% of the property appreciation back to the state for reuse in the program. These are some of the outcomes that we hope to achieve through this, particularly asset building for a wide range of households. And we are at the stage now where we have 25 co-sponsors for HR 3316, which is the bill in the House. We are looking for additional co-sponsors from either party. And if you would like to participate in this, in lobbying for this bill, then we encourage you to contact us either through our website, neighborhoodhomesinvestmentact.org, or contact Chris Siglin at the Neighborhood Stabilization Trust. Thank you.
Thank you very much, Carey. I want to let folks know that we are keeping an eye on your questions, and I will get to as many of them as we can once we get through our other panelists' presentations. So please keep the questions coming. And there may be some that we're able to answer within the chat, but I will try and use the time that we have to answer some of these questions from the panelists themselves in a group discussion. So with that, I'm going to turn it over to David Mann, who is the president and CEO of the Lucas County Land Bank in Toledo, Ohio.
Thanks, Rob, and thank you all for being here. I think this is a great conversation about finding tools that meet the needs of our community. So we are a land bank. I think many of you have worked with land banks. We deal with vacant and abandoned properties here in Toledo and Lucas County, and you can see that we have a significant challenge to deal with them. Every one of those orange dots is a likely abandoned property that may need attention and is, as you can imagine, probably in your own communities, the effects of a century of discrimination have concentrated that, particularly in low-income communities and neighborhoods of color. But we've worked for 10 years and we're making, I think, meaningful progress, equitable progress toward changing that for the benefit of our neighborhoods. And you can see sort of a host of different ways in which we've done that. One of the ways that we've done that, though, is to help bring homeowners together with properties that can be a good home for them. So not only bringing an abandoned property back to life, but creating homeownership opportunities wherever possible to support that neighborhood and help particularly communities of color build wealth in a way that we know homeownership does. The challenge, and I think Carey explained it well, because Toledo, no different than Hartford in this respect, is that there is a gap, in our case, somewhere between $20,000 to $50,000 between the cost of renovating a property to make it a home and what it might actually be worth when we go to sell it. NIA, I think, will help us to address some of those challenges. And this is a map of Toledo. All of those blue areas are areas of Toledo and Lucas County where NIA projects would be eligible. And you can see it's, I think, a substantial portion of our community, I think, highlighting both the challenge that we face, but also the opportunity to make a difference. And I wanted to zero in just briefly on a property that we renovated this year. Obviously, NIA is not the law, so we didn't have a chance to use it, but I think this example helps to illustrate, in addition to the ones that Carey just talked about, how this might actually work. So this was an abandoned property. This is a property that, as you can see, needed a significant amount of work and could have been demolished if we couldn't figure out how to make the math work. It needed a new roof, new foundation wall rebuild, paint, porch, windows, all new systems, a new kitchen, a new bathroom, a new everything that you could imagine this house needed. And when we worked it all out, it was a $130,000 project with about $108,000 of construction costs. We looked carefully at the market and we thought, okay, in very good shape, this house might sell for $85,000. So if it's going to cost 130, we have a $45,000 gap. And in a normal context, I think the challenge for any organization would be, how much effort are we going to put into it, and how likely is it that we can actually fill that funding gap? That's a substantial gap that it may take just as much time in some cases to try to fill that gap by finding and cobbling together resources as it does to actually do the project and create an opportunity. But here's how I think it would have worked if NIA had been the law. Same costs associated with the project. But as Carey showed, the $108,000 of construction costs, we would have been able to receive 35% of that back, or $37,000. And in this context, also the market in the real world that we worked in, because we did find the money to do this project, so we were able to sell it for more than we thought. The market has been strong, I think probably in many communities. So that also helped to fill some gaps. But again, that $37,000 helped us to find, not just have the princely sum of a net return of $2,000, but much more importantly, to be able to turn this property into someone's home, into an opportunity to further stabilize that block, to create home ownership. And these projects are hard. I think everybody knows that, particularly for land banks acquiring abandoned property. You find properties in likely the worst state, but with the capacity of your teams, with the resources in your community and sufficient funding, you can turn almost anything potentially into an opportunity for the neighborhood and for home ownership. And so this is what we were able to accomplish. Happily, like I said, we were able to cobble together local resources to fill this particular gap, but capacity-wise, we hope that NIA can help us fill a lot more gaps as we go forward. So thank you.
Thank you so much, David. I'm now going to turn the mic and the share screen over to O.G. Alexander, who is the Executive Director of Home by Hand, which is a community development corporation located in the city of New Orleans, Louisiana.
Good morning, everyone. We'll get this started. Hello, my name is O.G. Alexander, Executive Director of Home by Hand. We are a single family nonprofit affordable housing developer. We focus on specifically on home ownership, and specifically because of the potential for family wealth generation. I've had the incredible fortune to share an office with Carey for 8 or 9 years. I'm going to talk a little bit about the work that we do, and some of our project mix, and how NIA could really be impactful to us, to the city of New Orleans and us as an organization. As I mentioned, we're a single family affordable housing developer. We build beautiful new construction, energy efficient homes, storm resistant homes that are elevated above base flood elevation. We use a pre-sale model, which allows us to give our buyers time that they need to become mortgage ready. Our buyers are involved in the process. We provide a level of home buyer training. We also provide a level of homeowner education. We're not only helping our applicants be prepared to become home buyers, we're preparing our buyers to become knowledgeable and successful home owners. We also provide a level of post-sale stewardship, which I think is unique as compared to some of our peers. And we've always kind of subscribed to the belief that affordable housing doesn't need to be synonymous with substandard housing. We really strive to provide the same experience for our buyers that their wealthier counterparts get to enjoy. So why NIA? As I mentioned, I spent a lot of time working with Carey Shea here in New Orleans. In New Orleans, we really kind of define New Orleans in two ways, pre-Hurricane Katrina and post-Hurricane Katrina. As Carey and I worked on the recovery post-Hurricane Katrina, we saw that as the recovery dollars and the philanthropic dollars started to dry up, we noticed that our development output really started to diminish. But yet the rental housing industry, the rental housing developers seemed to be thriving. And in part, they thrived because they had the reliable mechanism of LIHTC. And there was really just nothing like that for home ownership, for single family home ownership. The value gap that Carey mentioned is really what inhibited us from developing the housing that we have the capacity to develop. It's really kind of, and it caused us to really kind of have to be creative. We really kind of had to string together a bunch of small projects to kind of make our numbers work. It was, unfortunately, we saw a lot of our nonprofit partners have to close their doors just because they couldn't develop enough houses, to hit their budgets. I'm going to talk a little bit about that mix, and again how NIA could be impactful for us. The first project that I'm highlighting is actually a unicorn. New Orleans is a mixed market. This is a particular project. Here's an example of a project that was our Choice Neighborhood Initiative, which we partnered with the city of New Orleans. A 1,300 square foot, 3-bedroom, 2-bathroom house, which is kind of our sweet spot. Our total development cost was about $205,000. In this particular situation, this house appraised for $280,000. So there really was no value gap. I use this as the first example because Treme and the 7th Ward are two historically African-American neighborhoods whose housing costs have seen really sharp increases since Hurricane Katrina. The unregulated short-term rental market really kind of did a number on this neighborhood. And we found a lot of residents really just not being able to stay in their homes, but also not having options elsewhere in the city. So in this particular situation, all the funding really went directly to the home buyer. We haven't seen any kind of funding like this since, and I really don't believe we'll see anything like it from the city again. The second project, this is through our residential construction lending program, where we partnered with the New Orleans Redevelopment Authority. This program is really an example, a good example of most of the work that we do. This project was in Gentilly, which is an area where we've done most of our work. Again, the 1,300 square foot, 3-bedroom, 2-bathroom house. Our total development costs on this house was about $200,000. The house appraised and sold for $175,000. So there's the value gap. And again, it's not a super significant value gap, but still enough of a gap to for us to be able to be able to complete projects like this. So there are a couple of neighborhoods that we haven't been able to develop housing in. And again, strictly because of that value gap, that we think that NIA could really be impactful. These neighborhoods, they check off a lot of the boxes that NIA is trying to address. Just this map to give you a little bit of a context. The green area, that's Gentilly. That's the area where we've done most of our development. The issue with the first two projects that I highlighted are, again, the scarcity of subsidy. Land is becoming more scarce in those neighborhoods. As that value gap starts to shrink, so does our ability to be able to acquire land to make our numbers work and to complete these projects. But what's unique about these two neighborhoods, the lower 9th Ward, which is highlighted, which is the red highlighted area, and New Orleans East, which is highlighted in orange, both of those neighborhoods suffer from a high percentage of blight and vacancy. And here in New Orleans, because of Katrina, we've got a lot more vacant land than we do actually vacant structures. Both those neighborhoods have had higher, historically high homeownership rates, higher than the rates across the rest of the city. The average income for both of those neighborhoods falls way below the 140% AMI threshold, and they have both are historically African-American neighborhoods. Just a little demographic snapshot of the lower Ninth Ward. As I mentioned, everything in New Orleans is pre-Katrina, post-Katrina, but you can see in the lower Ninth Ward, demographically, majority African-American neighborhoods. Average household income pre-Katrina was about $40,000. Post-Katrina dropped down a little bit to about 33.5. Home ownership, lower Ninth Ward, 59% pre-Katrina as compared to the city at 46.5%. Even post-Katrina, 48%, which is really significant because the lower Ninth Ward lost about 10,000 residents after Hurricane Katrina. We actually do have a real world example of a project in the lower Ninth Ward. This is now more along the lines of what reality looks like for us as far as appraisal gaps. Again, this is another project that we partnered with the New Orleans Redevelopment Authority. The same 1,300 square foot, 3-bedroom, 2-bath home. Development costs about $205,000. This house appraised and sold for $142,500. So you can see a very significant value gap. The New Orleans Redevelopment Authority was able to step in and fill that gap. But the issue with that is, we're very, very dependent on the Redevelopment Authority to actually put these RFPs out. They only put out RFPs once every other year, sometimes every 3 years. This particular project was really just a drop in the bucket. It was a 10-house project split over 4 developers. We got the highest allotment in 4 out of the 10 houses. So again, New Orleans Redevelopment Authority was able to step in, but again, really small scale projects, not as impactful as we'd hope. And as we move on to New Orleans East, again, a much larger area than the lower Ninth Ward as far as land mass goes. Again, demographically, majority African-American. Average household income is higher than the lower Ninth Ward, but pre and post Katrina still well below the 140% AMI threshold. And again, home ownership numbers, 61% pre-Katrina, 54% post-Katrina, but still higher home ownership rates than New Orleans, than the rest of the city of New Orleans. We actually have never been able to complete a project in New Orleans East. We actually own a number of lots out there, but because of the value gap and because of a lack of subsidy, we've never actually been able to develop out there. So these are numbers based on comps. This is kind of what the appraisal gap looks like here in New Orleans East for that same 1,300 square foot house. Total development cost of about $205,000. Based on comps, these homes are appraised for about $161,000. So again, a pretty significant value gap. So really, what are the broad impacts of the Neighborhood Homes Investment Act? For the city of New Orleans, I think it would be, again, a very effective and reliable vehicle to deliver affordable homeownership to New Orleans, to a city that desperately needs affordable housing. Specifically to neighborhoods that have historically been African-American neighborhoods that have not seen the investment that the rest of the city has seen post-Katrina, and neighborhoods that historically have had home ownership rates and have desires to have high home ownership rates. A secondary remedy is that, like I said, we've got a lot of vacant land in the city. So developing new housing puts land back into tax commerce. Again, tax commerce that the city desperately needs, especially with the economic downturn of the pandemic. For the organization, I think the most significant impact is increased scalability and development output. We've, like I said, we've got to cobble together a bunch of small projects to, we have to look for a lot of other revenue sources in addition to our developer fees. We rely heavily on philanthropy. Putting those things all together, it really is kind of a balancing act. The gray hair might be a little bit of an indicator. I think increased scalability can really allow us to start thinking a little bit bigger. And another potential for NIA is it will allow us to transition into owner-occupied double units, which is something that we've been talking about and working on. Most of the zoning in the city of New Orleans are zoned for double units. So we can provide ownership opportunities for low and moderate income, income buyers with the potential for some income. It would certainly decrease our reliance on philanthropy and finding other new revenue sources, and allow us to just do what we do best, which is produce affordable housing and get it out there to market. And all in all, just really ensure the long-term sustainability of the organization. I just kind of want to finish with this opportunity to think big. Just to put it into context, for our 2021 budget year, we had to put together 5 distinct projects to make our numbers work. And if we use LIHTC as a model and we could predict what NIA would do for us, it would allow us to start thinking about 5 years, 10 years down the road, instead of just year by year. So we're very, very excited about the possibilities and look forward to the benefits. Thank you very much.
Thanks so much, OG. Christopher Norman is the Executive Director of the Fulton County City of Atlanta Land Bank Authority, and I'm going to turn it over to him.
Good afternoon. Thanks everyone for joining us today for this webinar, and thanks for the invitation. I have a few slides and really just a few touch points that I want to share with the audience, and then engage in, I guess, Q&A. And I know that Robbie has some questions for us to that we could basically participate in. So really just kind of want to give you context to Atlanta, to the metro market, for those that are not familiar. So we have been a fast growing part of the country in the Southeast. Some people refer to us as the debatable capital of the South. And so we've turned into one of the fastest growing, and this, I'm speaking of the metropolitan area, third fastest growing metro area in the United States. So while there's a lot of interest in our area, you'll see that we've, in addition to attracting people, we've attracted employers. Our tech sector is doing well, health sector is going well. Of course, we're home to the CDC, we have Georgia Tech, we have Atlanta University Center, Georgia State, quite a few of Emory University, colleges and places that would attract people to our region. So during the same period of time, you've seen the income consequently increase. So last 15, 20 years, income's going up by 48%. But correspondingly, rent, which is kind of a, you see some correspondence to home sales, has outpaced the income gains over this period of time. And so when you start looking at the numbers and trying to figure out, well, what does that mean for the area? You'll see that, while 15% of our area residents earn over 150,000, over 27%, over, that's a quarter of the people earn less than 25,000. And so what you see is you really dive into the numbers in the Atlanta or the region, we become a tale of two cities. And so we share some of the dynamics that have been mentioned by other panelists in terms of the affordability and accessibility of property in these other markets. Same thing applies to Atlanta. And so over half of our residents are considered cost burden at this point. So that means they're paying over 30% of their income for housing and utility. And one thing about Atlanta, if you've been here, we're known for our traffic. Pre-COVID, there was a lot of need to drive a lot of places. We have transit, but it's limited in terms of how far out it goes. And so once you start adding that in, this really pushes this number up even higher. So And so the new construction, there has been quite a bit, but it's really been focused more on the high-end luxury. We see a lot of luxury apartments. We see a lot of high-priced townhomes and infill lots. And so, as far as the same time we're gaining that, we're also losing affordable units. And this should actually say units of affordable housing. So we're losing over 1,500 units per year in affordable housing. And so when the mayor came into office, she recognized, she conferred with our housing subcabinet and the House ATL group, which was started in Atlanta, to basically create a goal to create and preserve 20,000 affordable homes by 2026. And that was based on her serving 2 terms as mayor. And so this was also formed by a group called House ATL. That was a group of about 40 organizations throughout the city, private and public sector. And they really started understanding that while we have the prosperity, we still need this need for housing. And of course, there's uneven distribution of these gains across the city. It's a north versus south. You saw some of the maps that were presented. I'm going to show you guys one as well by the other panelists, how it's kind of localized to certain areas of the city. In their areas, same thing applies to Atlanta. So there's been over the last 10 years, prices, home appreciation prices have gone up almost 4.5% per year. So you kind of do that, the aggregate impact of that, gets to a fairly steep and consistent escalation of home prices. And so we continue to find an attractive market here for folks. And the Atlanta Regional Commission, one of our big areas, has actually estimated that Atlanta metro area will reach 8 million people in 20 years from now. And so the city of Atlanta, even though we're the largest city, we are at 500,000, a little over that. And so, and bear in mind that we have gained about 50,000 residents in the last 7 to 8 years. So we've had a tremendous amount of growth. So we have our local CDCs, our local nonprofits. We have folks that are interested in basically creating housing opportunities for this. But similar to other folks that I've mentioned before, they're having trouble keeping up and scaling. And so it continues to be this need for subsidy to upgrade these older properties and also to build in areas where the market has not returned or doesn't have this price escalation. So while this great stuff is going on, there's still parts of the Atlanta market that have not have had this appreciation. There were instances where the land bank, there was one area of Pittsburgh, it was a collaborative between Pittsburgh and the Casey Foundation, local nonprofits, and land bank bought properties there for $20,000 in 2011, 2012. And those were rehabbed and put onto the market. But in a lot of instances, there was an appraisal gap, and the neighborhood stabilization program helped to fill that gap. In that same market, we have a development here called the Beltline. Beltline is one of the largest urban infill projects in the country. That has such a gravitational pull that same neighborhood where we were basically buying houses for $20,000 and rehabbing them with partners and putting them back on the market, they have now hit $300,000, whereas they were selling for $110,000. And that's over the course of 10 years. And so, but that's one market in terms of escalation. So of course, the subsidy we're talking about would not apply in that scenario. The many other neighborhoods that basically do not have that same level of appreciation. And so we need this subsidy to create scale, to basically come into these neighborhoods to do this. But you also have an issue of the racial equity and wealth building. OG kind of alluded to that when he was wrapping up. That remains an issue in Atlanta. Even though we are a majority Black or African-American city, that still remains an issue there. So I'm going to just exit out here and show you this map here. So this was a study we did in Atlanta, and these are the boundaries of the city of Atlanta. That basically, we did this about 7 years ago. So what this shows you is the north side of town, very, what you would call very stable, exceptional appraisal values. And then you kind of see there's a divide through the belly of the city here. And then as you go south, the job centers are primarily north. A lot of the affordable housing is south. And so the housing in these areas south of the city, there are very healthy pockets. Very wealthy people still live there, but there are also a lot of neighborhoods whereby you still have the appraisal gap that is present. And as Atlanta fills in all these gaps, Atlanta tries to basically find homes for all these 8 million people that are coming to the metro area, there's a need to do rehab, upgrades, infill of these areas of town, but also to create them in an affordable fashion to basically allow all income bands to occupy the city. And so that speaks to the mayor's goal of the 20,000. So I did want to kind of give you context to our market, our dynamics, the fact that there even exists a need in an area that's demonstrating such tremendous upside growth for this type of a product. So that really concludes my comments here, and I wanted to turn it back to Rob because I know there are questions from the audience, and we'll be happy to share them.
Thank you so much, Chris. Everybody in the panel, please feel free to turn your cameras back on. I want to thank everybody for being so active in the both chat box and in the Q&A, and also thank the panelists for who've been able to work on the fly during the presentation to answer some of the questions already. But there were a couple of questions that I did want to uplift for some discussion. The first of which is, and feel free, anybody, but I imagine Carey is probably going to be the one to field this, at least initially, to just talk quickly about the way the NHIA program allows existing homeowners to leverage it to do their own improvements or to benefit from the tax credit, because that's been a pretty consistent question we've had.
Yeah, and before I answer that, Justin, would you mind unmuting Chris Siglin? She's also, I noticed, on the call, and she's leading the Neighborhood Homes Coalition these days and may be able to help with some of these questions. The Neighborhood Homes Investment Act tax credit can be used on owner-occupied housing. The way it would have to work, however, would be that a sponsor would have to apply. So LISC, Enterprise, a city agency, another charitable organization would apply as a sponsor to the Housing Finance Agency for a set aside of tax credits to assist homeowners in the rehab of their homes. And there are a number of requirements for eligibility for the homeowners, but this would not be something that homeowners applied directly to the state for tax credits. It would be done through a third party.
Great. Also, another question about sort of how some decisions were made in getting to certain places in the NHIA legislation. There were some questions about the threshold, and particularly how 140% of AMI was arrived for the end user homeowner occupant versus some other number that might be higher or lower. No, I know a lot of sausage went into that sausage making. So.
Yeah, I was going to say, this is probably the most sort of controversial topic. You know, we didn't quite come to fisticuffs over this, but it was pretty close a couple times. You know, here's how it sort of broke down. You know, we had some really dedicated housing professionals, affordable housing professionals around the table designing this thing. And they had dedicated their lives to serving low-income people, folks at 80% or less of AMI. And then, you know, there were a couple housing developers around the table, myself included, who also had dedicated their lives to serving people at 80% or less of AMI, but had seen how tough it is to build a home and then find an eligible buyer who is very low income, because it's not, you know, anybody who's done it knows that, you know, you're not finding someone to buy the house, you're finding someone who can qualify for a loan. And qualifying for a loan is very difficult, particularly for people who not so much are low income, but who have high debt to income ratios. And unfortunately, low-income people, particularly people of color, have enjoyed, less generational wealth, and consequently have had to take out debt for cars and homes and cars and school loans and so forth. And so what we found was twofold. Number one, this program needed to be successful, and success meant not only renovating a house, but putting an eligible buyer in that home. More importantly, this really isn't an affordable housing program. It's a neighborhood revitalization program. And we are looking to help create, healthy neighborhoods with good income mixes, and be able to, retain families that had, exceeded the 80% AMI level and would love to live in the neighborhoods, but had to seek homes elsewhere because they didn't qualify for so many programs. So it was a tough one. I would say 140, was the compromise. And hopefully at some point after, the program is up and running, there'll be the opportunity to maybe revisit this.
All right, I'm going to take you off the hot seat for a second, Carey, and ask David and OG and Chris. So one of the, I know from being involved with the coalition, what we're hoping this legislation, if implemented, could drive is having it be one tool in the toolbox to help close both the home ownership gap as between white households and other Black and Latinx households, and also as a result of that to drive the wealth disparity between household wealth between those demographics. Wondering if you guys can talk a little bit about how you see that actually playing out on the ground, because I want to make sure folks are thinking about this not just as a tool of investment, but as a tool of furthering racial equity.
I could speak about that a little bit from the development standpoint. We've been fortunate in the fact that we've had about 10 years of value engineering and figuring out the recipe to deliver affordable home ownership. One of the reasons that when we incorporated Home by Hand that we changed over to the pre-sale model is because like Carey alluded to, the traditional model of building a house, putting a for sale sign on it, even with subsidy, when income is really the sole determining factor, we were finding that lower income folks, but higher wealth individuals who were ready to buy a house were the ones who were getting the homes. And their lower income, lower wealth counterparts who needed time for credit repair and to clear up debt. By the time that they got to that point, those houses were long gone. So the pre-sale model has allowed us to give people time to become mortgage ready, to clear up their debt, and know that house is still there, that at the end of the tunnel. What it also has allowed us to do is it's allowed us to treat housing as all of our houses are programs. So fair housing laws say that I cannot penalize you from not having been affected by Hurricane Katrina, or I can't penalize you because you don't currently live or rent in the neighborhood. But what I can do, if our applications are all treated equally, scored the same, I can give you points for, the first example I used, that Treme 7th Ward neighborhood. We can give points to somebody who's currently living in that neighborhood and who is, who's facing displacement because of the values. I think the other important piece, and then I'll pass it on. When I talk about scalability, this notion of being able to create more affordable housing opportunities also gives us the opportunity to create other types of affordable housing opportunities. We've recently partnered with the Crescent City Community Land Trust, and we helped them create the first traditional land trust for home ownership in the city of New Orleans. So again, it's just another tool. The city has been a little bit slow to embrace the land trust concept. But again, we have to be very selective with the projects and how we execute them. But the notion of being able to scale and being able to create more opportunities also gives us the ability to create different types of opportunities to help serve and again, and be able to target within the law who we serve.
David or Chris, in our last couple of minutes, gosh, an hour goes fast.
Sure, I have comments. David, did you want to go or?
Oh, go ahead, Chris.
Okay, so I think you think of two things, conversion and kind of a shot in the arm. So conversion, meaning that a lot of these neighborhoods, we have a lot of high level rental in these neighborhoods, particularly where there's concentrated, there's transition going on. We found neighborhoods with 85% of the property being rented. And so if there's an opportunity to basically upgrade those properties and to basically create opportunities for home ownership for these same residents, I think this would be a big shot in the arm to, and so when it's been shot in the arm, this would also be a shot in the arm of our nonprofit developers and giving them access to capital that they sorely need. Because right now they're just really reliant on your traditional sources. And as Carey pointed out, it typically doesn't fall into the single family home or small home. It's typically been the larger multifamilies, right? And so this would be a great shot in the arm to move these people to a position where they could actually have ownership opportunities. And that starts contributing to wealth accumulation and get into that game. We've also seen in Atlanta, our market, a 5% decline in home ownership by Black families over the last several years. And that pairs with some of the trends across the country. So this would help to kind of stem that, reverse it, and create these housing opportunities in the same neighborhoods where a lot of these folks are already resident. So I would say that's kind of the short answer to, how could this basically help to contribute to building? Well, because basically you're creating the opportunity or expanding that opportunity for home ownership in those particular areas.
All right, David, you get the last word before we turn it back over to Justin.
Yeah, briefly, I think separate from new home ownership, which is important, we had lots of existing people of color who were homeowners before the crash, so the value loss in those neighborhoods was substantial. That is one of the ways that wealth was sort of robbed from people through no fault of their own. Building those values back is an opportunity, I think, to build wealth on top of all the other great things that OG and Chris and Carey have talked about in the ways to think about this, because there are serious inequities in appraisals. I think we all understand that. But a comp is a comp, and it doesn't just set a value for that particular property. It helps set a value for the whole neighborhood in a way that can, I think, build wealth over time.
I'd like to thank everybody and apologize profusely. There are so many good questions about how do we reform the appraisal industry? How do we close the appraisal gap before NHIA gets passed? And I encourage folks to reach out. Justin, I'll provide some information to close us out with being able to follow up with our presenters directly. And thank you for being a part of this conversation. The one thing I do want to encourage folks to do is please visit the cumbersome URL, neighborhoodhomesinvestmentact.org. Not only is there a great deal of information about the legislative proposal and some frequently asked questions, but there's a map tool that will help you really in your own communities. Type in your city, type in your state, and you will see the census tracts go live that really demonstrate how targeted this is and how the different factors that were built into the NHIA sort of screening tool for eligible census tracts will play out in your communities. So what that also does, to answer another question, the default that you are brought to on that map tool is by congressional district. So for those who are interested in trying to generate support for this legislative proposal, please feel free to take a look at that mapping tool, identify your legislator, and let them know that you support this going forward and think it will make a real difference on the ground. So Justin, I'm going to turn it over to you, even though we're already over time.
All right. I just want to briefly, once again, thank our presenters and really thank them for sharing their time and their expertise and their knowledge. I also want to say thank you to Rob for pulling this together, and thank you to everybody who attended today. As you're leaving, a survey should pop up. Please take a moment just to fill out the experience survey. Let us know, how the webinar went for you today. And With that, I hope everyone has a great afternoon.